When fear grips the consumer, people tend to panic and act on emotion. But history shows those are often the moments where the biggest wealth opportunities are born. In today's stock market brief, we're seeing clear signs of growing uncertainty, consumer stress, shifting expectations, and while cracks starting to form, the question now is, are you prepared to act while others hesitate? In today's stock market brief, that's what we're going to be discussing amongst what we typically do. Market conditions, expected moves. We're going to give an update on the bottom finding charts here too as well. We got a lot to discuss. These episodes are brought to you in partnership with Interactive Brokers. Make sure you check the link that's pinned in the comment below. They have an Interactive Brokers campus with a whole host of free resources and tools, including courses from beginning to advanced. And a big thanks to my Patreon community that continue to show up and support this channel. It's $9 a month. It's even less if you pay annually, and you get a whole host of benefits. Let's get into today's show. Hello, everybody, and welcome back to the show. We're starting off here looking at a lot of uncertainty in this market, and there's a great chart right here that depicts this. We're talking about no landing, soft landing, or hard landing as far as our economy goes. And what do you notice here? Well, you see a big shift right over here to the right-hand side in the category of a hard landing. Everyone and their mamas did not expect us to see a hard landing. However, we sought to see no landing, and out of nowhere, very quickly, all it takes is a little bit of market volatility, well, quite a bit, and the expectations for a hard landing in our economy have dramatically increased. Take a look at this. This is the gap between the highest and lowest year-end S&P 500 targets. What is that? Simply put, you get a bunch of different banks, bunch of different big wigs, and they say, hey, I think the S&P 500 is going to 7,000 this year. I think it's going to 6,500. Well, they take the lowest and the highest, and they look at that spread, and take a look here. No one knows exactly what they're talking about. This is the highest reading that we've seen dating back to as much as data as we have, 2000. So there's a big spread between the highest targets and the lowest targets. Meanwhile, we have corporate and retail still buying this market, but yet hedge funds and institutional clients, they are continuing to sell. What are they buying over here? Well, if you take a look from Bank of America, it looks like they're flooding into consumer discretionary and technology stocks. But you don't need to look far, because retail investors' speculative appetite for the 3x leveraged ETF has absolutely exploded as far as weekly flows go. But if you take a look at the fund manager survey, this is fund manager investors. What are they planning on doing? Well, they're also here wanting to get underweight, and this is a level that we haven't really seen for a long time now. If you take a look at foreign-based U.S. equity funds, these are showing the second largest one-week outflows in history, according to this specific data. CTAs, which we've been tracking, have been net sellers. This is actually 2 percentile over here, so for some pretty extravagant readings, not only in CTAs, but also in vol control funds here, adding to the sell side that we've been seeing in equities. The current percentile here is 1%. The last time we were at these levels, well, was the pandemic, and prior to that, we were looking in January 2011, middle 2011, and that was when the Fed stepped in with what's known as Operation Twist. Now, back to the CTA position, what I do find interesting here is basically in every single scenario over the next week or the next month, well, the flow looks like they're going to end up being buyers, and it doesn't take much to look. I mean, they've been huge net sellers, so eventually this is going to flip back around. Now, will that add to a potential larger term bounce here in the near future? Perhaps. We'll get back on that in a little bit, looking at those specific charts. Sentiment, fear, right, remains at extreme levels that we haven't really seen since 2020, the pandemic. Prior to that was over here in 2011 during Operation Twist, and then also the great financial crisis. So consumers, to say the least, are getting fearful. Sentiment is getting extreme. If you take a look at this, this is the Consumer Sentiment Survey by Michigan University, I believe it is. And this is I think this is dating back to when they started in the 1960s. And you can see over here, this is the most recent reading in 2025. The last time we were down here was basically around the bottom of 2022. Prior to that, we had, I don't know the exact date here, is probably around the Operation Twist time, and then the financial crisis. You had the early 80s over here to late 70s and so forth. And the reason why I'm bringing this up is because during times where the consumer is incredibly scared as far as when we're thinking of terms of confidence, right? They're well within the area of being very uncertain and not having a lot of confidence in this current market, in this current economy, in their own economic standing. And if you take a look at economic conditions index, this is also quite suppressed, not seen since, well, the bottom of 2022 and levels since the great financial crisis, both of which became amazing wealth building opportunities for those that were prepared. If we take a look at expectations that the consumer has, also getting pretty depressed levels over here, not seen since the bottom of 2022. We had about the 2011, the great financial crisis. Back over here, we take a look at the late 70s to early 80s. If we keep going on here, look at the other data that they provide. This is expected change in prices, so the median price increase that they expect during the next year. So they think prices are going higher, which, I mean, I get it, right? They have been going higher. Now, what about expected prices in the next 5 years? Also seeing a large spike over here. So while consumers are just feared up, while sentiment is extremely low, what we said at the very beginning is that's typically when they are panicking, they act out on emotion, they're not prepared. And, well, what do investors do? Well, they fly to safety. This is the most crowded trade right here, apparently, according to B of A, long gold. And, well, rightfully so, because gold has been one of the stronger performers. I mean, even last year it did great, but this year it's doing good too as well. Let's take a little bit deeper look into the consumer. If we take a look at the number of accounts by loan type, look at the credit cards accounts that have been opening up over the years. Well, it's been in a steady rise. It's a steady increase, meaning more credit card accounts have been establishing, being opened. As far as credit card balances go, this has also been on a constant rise over here, while interest rates remain rather elevated to levels that we haven't seen, right? And we're talking 20+% on that credit card interest rate. And then if you take a look at delinquencies, let's look at the serious ones that are 90+. Take a look at this credit card spike right over here. We're seeing a large spike in credit card delinquencies not seen since the great financial crisis. If we take a look at who's really causing this by age, 18 to 29 has been seeing a big spike. 30 to 39 is getting their act together these last couple of quarters as it's coming off, but it still remains rather elevated. As far as collections go, less people are in collections, but the people that are in collections, well, they are feeling the brunt of it as the amount of collections has been on somewhat of a rise, meaning that what? It means that the people that aren't doing good are doing worse, and the people that are doing good are still feeling some pain as we currently stand in this economic condition. Okay, if we take a look at the probabilities of a recession brought to you by the Federal Reserve, we had a high probability of a recession here in early 2025 to late 2024. And all of a sudden, that's dropped off a rock as of recently. So the probabilities of a recession based off of them have come down a bit. But notice how big spikes have led to recessions. Big spike, recession, big spike, recession, big spike, recession, big spike, recession, big spike, and a big spike over here too as well, dating back to the 60s. So are we getting through this without a recession? That could be a possibility. So we got to look at the data. But what is a recession? Well, a technical recession, albeit apparently it's changed, is 2 quarters of negative GDP growth. Well, if we take a look at I believe it's called the GDP Now forecast by the Atlanta Fed, they are estimating currently 2.4%. That was as of April 9, 2025. You can see their Fed estimate right now. So if we get negative quarters, that means growth can be coming to a halt and going down, which could cause a potential recession. Now, if we take a look at the data as far as bear market drawdowns in the S&P 500, you can see times that we went 10%, 20%, 30%, 40%, 50%, 60%, and so forth. Down over here, well, the levels over here that the red arrows are pointing to are periods where we didn't have actually recessions, but yet we still went into bear market drawdowns. So how long did the bear market duration last when there was no recession? And you can see here, if I draw this line across, this is in months, and each time we're actually below 12 months. August 87 was quick and abrupt. January 2022 lasted almost a year, but it was all well within there. So we did draw down over 20%. So how long will this bear market last? Would it be under 12 months, meaning that there could possibly be no recession? Or if we do end up going to recession, are we going to start to see what we typically see above 12 months to around 24 months on average, and sometimes slightly there higher? What are the professionals doing? What are the goats of investing doing? Well, let's take a look at the GOAT known as Warren Buffett, right? Berkshire Hathaway's cash pile rises to new record highs. We pointed this one out before. So when they're going into cash, what does that exactly mean? It means that they're taking risk off of the table and putting it into something a little bit more safe, right? That's how I would interpret that. If you take a look at the Buffett indicator, which takes into account US stock market value, dividing it into the annualized GDP, you get spit out a number, and that is 211%. But what's that number do with no indication of prior history? Well, let's take a look at prior history. This was as of December 31st, 2024, and you can see we are above 2 standard deviations. The last time we were over here was going into the 2021 to 2022 top after the Fed bazooka cannon, the money supply, and we absolutely got brought back down to 1 standard deviation. So now we're way back up over here. And as of recent, the last time prior to that, not really recent, it was in the 2000s. The other time that we hit the 2 standard deviation was in the .com top up here, as you can see. And we're well, I don't know where we are now because I want to see an update after a few months, but we're well extended as it stands. Take a look at credit spreads. This right here, this middle line is credit spreads. The thing in red is actually the VIX. And you can kind of see when credit spreads start to rise or when the VIX starts to rise, there's a possibility that credit spreads obviously move with that. And we saw a pretty large spike. I mean, it doesn't look large, but we saw a big move, a blowout in credit spreads. It kind of subsided these last few days. And that brought in a lot of fear into the markets as we've been seeing volatility rise overall. Now, it's not till we get to an around 8 to 10% where we start to begin to really panic, where we begin to really capitulate in markets. So we're not actually there yet. But I wanted to call out a couple interesting things. When we reach out into these areas, if you just look down the chart over here, what do you see the federal funds rate actually doing during these times? Well, they typically move them down to 0 or they act fast and do something. Now, you might say, well, what about 2011? Well, rates were already down there. Okay, Mike, well, what did they do? Well, they did Operation Twist. What did they do over here in 2016? Well, they began to raise rates in 2015, late 2015, and as credit spreads started to blow out, we had all this uncertainty, they actually held rates steady and waited it out until later to start raising rates again. And as it stands right now, what are we doing? We are talking about cutting rates, having inflation come down. That is the talk. The market's pricing in about 3 to 4 rate cuts this year, and the Fed has yet to act because there are some interesting stuff developing in the very near term. As we get in all this news and tariff talk, take a look at the 10-year yield in oil. They've kind of diverged from one another. And which one's lying, right? Typically, oil is the leader here and the yields will follow it, right? So what do we see? We saw oil completely break down. We saw 10-year yields rise. So is the 10-year yield, is it going to come back off because oil is going down too? I think that's going to be an important one to watch because remember, if you look at high yield spreads over here, credit spreads, as this goes up, what do you notice oil doing down here? Oh, sensei. You see a big spike, and as we capitulate in high yield spreads, oil tends to hit a bottom. Capitulated, oil found itself a bottom. And as you can see, oil's been falling off as these high yield spreads shot up there too. And now oil has started to base out just a little bit these last few days, consolidating. But is it going to head lower, bringing down the yields with it in the very near future and potentially sending this credit spread higher? Okay. I want to also look at another interesting chart. This is the 10-year yield in the candlesticks and then the dollar too. These things move hand in hand, but I do find it interesting that the dollar has been falling at a very fast, rapid rate of change, but the 10-year yield also has been moving up here. So not only the dollar is falling with oil and oil's falling, right? There's typically a negative correlation there, but they're currently correlated. And then you see these typically correlated, but those are breaking correlation. So clearly there's a lot of uncertainty, a lot of fear going on in these current markets. And who's the big liar here? Well, we're going to find out. That's going to happen at some point. What's happening to the S&P 500? Well, we had this big weekly reversal candle. This is known as a piercing pattern. It's where you gap down, you go lower, but you close more than 50% in the prior candle. They're known as two-bar reversal patterns, and they're negated as soon as we take out the low, which is still a possibility, but that is 11% away. So it might be a while before we take that out. It might happen quick. Volatility is still here. But as it stands, we're below a weekly 5 EMA. in this current context, if you zoom out on the weekly time frame and you look a little bit deeper, we did come back into and around that 20, well, pretty much to a T. This right here is a 2021, 2022 top before going into the bear market. We came down. Let me just draw the perfect line across. We came down, boom, tagged it, and we found a reversal right then and there. So even if we come in, maybe even undercut it and scare, there could still be a possibility that we're trying to find ourselves some sort of footing. But we did get a deep reading on the RSI that we haven't seen for quite some time. Okay, that we bounced from there. And then also the MACD has been pointing straight down, but the histogram is starting to turn here as we're still kind of dealing with a lot of this overall volatility. Now, when we talk about large opportunities that come from all of this, when you see credit spreads blow out, right? When you see all this uncertainty, when you see all this panic, these are the type of charts I want to kind of revisit, that big picture chart, to give an idea of what's happened in the past. Okay, not to say that that's going to happen again, but you need to have some dry powder and you need to be okay with stepping into sometimes the fear, because as the market conditions start to begin to change to be more positive, we don't know if it's going to be a bottom, the bottom, or anything, but you want to be prepared for when it actually is and know what names are going to be coming out of it potentially as new leadership in a new bull market. And that's where most of this wealth is generated from. If you look at this, take a look at the yield curve, take a look at federal funds rate. When the yield curve starts to steepen from an uninverted state, when the Fed starts cutting rates, you typically actually go through a pretty volatile period. This is the dot-com bubble, 50% decline, 58% decline in the great financial crisis. The pandemic was quick, fast, but minus 35%. And what do we see here as we're starting to uninvert this yield curve, as the Fed is starting to cut rates? We're down 23-ish, 24-ish% from peak to trough. We're not down that much at this current moment, but that's what it was. So looking back through history, I mean, would you be shocked to see a 35% decline? I mean, it's a lot, so a lot of people would be shocked. What about a 50% decline? I mean, yeah, that's pretty crazy, to be quite honest, but where would that bring us? Probably to and around this pandemic area and around 3,250 to 3,000. That's just a rough math over there, which would be, once again, pretty dramatic. However, if that were to occur, are you going to have the funds or the dry powder necessary to navigate and to execute into that? Or are you going to be panicked, emotional stricken? The world's coming to an end when the world is about to turn around. And that's very important. Let's take a look at the conditions of the current market. We have the VIX futures curve still in backwardation. This right here means simply we got problems here and we got problems now. If you take a look at back month versus front month volatility, we're still below 1.0, which means you can typically find a bounce, start to level out a little bit. You want to get back above these areas. It typically finds tops and or periods of consolidation when we're back up here and at around 20%, which means back month is 20% higher than front month. And we're still rather, at pretty depressed levels over here. As far as the gamma flip line goes, this is day, 35 or 36 of the trading session that we've been below the flip line, okay? Now, this is one of my main key indicators for understanding when the conditions of the market can benefit me and for what strategy I'm going to use. When we're under a gamma flip line, I become more of a day trader. Shorter term holds. Maybe I fade trade, like if the market sells off really hard, I'll fade for a bounce up. Why? Because the gamma flip line tells me exactly how dealers are going to act. They're going to sell into selling. They're going to buy into buying. The volatility is going to increase. I've shared this many times and backdated proof of what it actually looks like utilizing like a volatility index and showing that. Don't have that chart with me now. So that is currently the situation. We've been under it for a while. When we get back above it, what happens? Well, when we get back above it or become gamma neutral, volatility comes in, liquidity increases, and typically you can see smaller up days and it kind of drags out. And this becomes a better environment, not for day traders necessarily, but it becomes a better trading environment from my perspective of swing trading, where you can hold longer, you can build bigger positions, you can trade the trend, etc. The next thing I look at is the direction of the 5-day moving average. And right now we're above the rising 5-day moving average. So I like to get a little exposure back in, but I'm very quick to kind of take some profits off. So I'm kind of trading in and out until the real conditions start to develop and to change. Right now, it's positive, but I wouldn't be shocked to see this thing tested, undercut, retested again, and seeing if we can shake out some people, if this is going to be something more bullish. I wouldn't be surprised to see some shakeouts, and we have some news overnight right now as I'm recording this about NVIDIA, and it's bringing the market down, so we'll see how that acts come tomorrow morning. Let's look at the expected moves. The expected moves, what are they? This is not lines on my screen. This is what the market anticipates for risk for the week ahead. And this year, they've been doing a decent job at it. We so far have had 15 weeks or so trading 15 various weeks in the year of 2025. And out of all of those, minus this one because it's not fully done yet, it's a shortened trading week, we've tagged the expected move every single time -1. Okay. Even when it was a $35 expected move or $30 expected move, whatever it was this week, the largest I've seen, we still tagged that and then we came back in. This week, second largest I've seen, $25 of expectation. That means that we can come right back down here to around 510, and that is well within the market's expectations of risk this week. Now, what's crazy is that this is a 4-day trading week, and we still have a $25 expected move of risk. Typically we're around $7 to $9. That's more expectations. So clearly, when volatility expands, right, the market sees more risk. These expected moves, they widen out, as we've talked about just here recently about back month from a volatility, backwardation, how we got problems now, as we're under the flip line, and so much more. So this is where the potential goal is for them bulls up here at around 560, but down here right at around 510. And I don't know if we're going to be tagging it this week. That's a big move, and we haven't really gone anywhere so far in these last 2 trading sessions. If we take a look at the 15-minute time frame, I want to give you the daily implied move. It looks so tiny, right? 530.50 to 544. Well, that's not tiny. I know it looks tiny on my screen, but let's be real. That right there is $7 of expectations. What's typically a risk for a week is for a single trading day. So that is still a lot of volatility. And what in the aftermarket session right now, we might be actually coming near that because of the news around NVIDIA. So right now, what do we see? We're seeing higher lows. That's positive. Price action today got very tight, choppy, whatever. Maybe tomorrow, because we contracted, we get a little bit more volatility in these markets. If we start breaking down from this, start looking at a 2 standard deviation move, $14. Okay. And that's right in line with the quarter to date volume weighted average price. And this was the low of the year volume weighted average price down there. And then we have your upper weekly and lower weekly levels, 558.92 to the upside, 508.96 to the downside, with a couple of trading days left in this week. This is the news that came out with NVIDIA, so I figured I'd share this one, but the expected move is 102.08 and 119.78 to the upside. And we had recent news that shares are moving lower in Tuesday's after-hour session after the company said it recently informed by the U.S. government that it will need a license to export chips to China. So this trade stuff, this tariff stuff, still going through it. One thing could be said, the market goes into a tailspin. So how do we manage risk? I look at expectations of risk and I try my best to navigate that utilizing various tools from a shorter perspective. So that's what we look like right now. I don't know what it looks like just shortly thereafter this or where we're going to open, but just be aware the market expected at least down here to 102.08 to up here at about 119.78. So at the moment, we're still well within expectations. Let's look at some of these bottom finding charts, give you some updates on these bigger signals. This right here, I like to use, we're utilizing the put to call ratio. We're utilizing skew. And if you take a look down here, that's the S&P 500. And what do you notice at these bottoms, this bottom of 2022, the bottom of the pandemic, you get skew to get crushed down. Okay, down to around 115. It doesn't need to quite get down there, but that would be the lower reading. Then what happens to put to call ratio? It kind of blows out to the upside into and around that 1.2 reading. That's the 10-day moving average of the put to call ratio. And you can see we've been moving up, which is not great for the markets. But as this thing starts to turn around and potentially head lower, maybe cross through 1.0, that could actually be a bullish sign for the market. And perhaps then, because we did get skew to come off these highs, go figure, right? You get massive hedging activities kind of leading up to this crazy write-up, and then all of a sudden, boom, hey, oh, there you go. There's the problem. That's what everyone was hedging for. If we take a look at the NASDAQ record high percent index, I like to look at this on a monthly time frame. This is a weekly time frame. This is a rather interesting breadth indicator when you get these kind of strong moves to the downside over here, and you get a weekly close below this 20% reading over here. And when that actually happens, you see a thrust up through 35. It's actually marked some decent bottoms as marked out here on my screen. This has been coming off, but it's still not really all too frothy to the downside. So I'm just giving the quick update there. Now the NASDAQ Cohen high-low index doesn't have a weekly close down here at 0.05, but last times that we've gotten these readings down here, it's marked shorter term bottoms and pops in the market. So I'm highlighting those on my screen too, like 2019, 2018, right? The trade whatever we called this over here, the Christmas Eve massacre, boom, that found a bottom. 2020 pandemic, boom, we found a bottom. Over here in 2022, we found some shorter term bottoms and some pops, but it wasn't the necessary big bottom until we got to right around here. And then you can look over here to the great financial crisis too. We saw some big rallies, faded to big rallies. We got faded, massive volatility here. And then eventually we did find ourselves the bottom of the great financial crisis. The last one is the old fool indicator, and this is utilizing the put to call ratio. We're dividing into the NASDAQ composite, applying some indicators on it, some EMAs, and we just look for crossovers. And the most recent one was right here. The green line crossed below the blue, gave us a sell signal. It's a lagging indicator. So it's still on a sell signal, and the market's been going down, right? The last kind of buy signal that we got was kind of right in around here, right in around here. You get a lot of whipsaws, but that's when the kind of market went higher. Then we started to chop around a bit and so forth. So it's a very lagging indicator, but I figured I'd keep an eye on it for when this crosses back above, again, whenever that may be. I hope today's video brought you some insight into the markets, what it is that I look at in these markets, and kind of gave you a different way to approach and look and anticipate things versus be part of the overall crowd. I want to close off by saying this. If you want to be prepared for an environment to build a lot of wealth, right? If you want to be able to be prepared to come out of something big, it's not about guessing bottoms. It's about starting slow and building into it. And if you're wrong, get out quick. If you're right, you can continue to build. And most importantly, when you start to look at some of these charts, this data that I've shared around consumers and consumer sentiment, it's typically ideal to do the opposite of what they're doing. So when credit card balances are going up because interest rates are high, delinquencies are increasing, when you come into an economic situation like this, you need to do your best to do the opposite, right? Pay off this consumer debt. Don't hold on to it during these times. Have some savings just in case if you were to lose a job, change a job, whatever it may be, right? Have savings. Pay down consumer loans. Credit, invest a little bit here and there. And then when you have extra opportunities to take advantage of big moves in the markets, take advantage of it, but make sure your house is in order before anything.